Welcome back. Today we are diving deep into a true titan. PepsiCo, ticker PEP. This is a 125-year-old empire really built on a simple, delicious foundation. Snacks and sugary drinks, foundational stuff.
Foundational, absolutely. But let's face it, the world has fundamentally changed. Wellness is the new obsession.
Totally. And the recent, massive popularity of GLP-1 weight loss drugs is absolutely rewriting consumer behavior. In real time.
And that is the central tension we need to dig into. Can that 125-year-old foundation actually hold up against this powerful, accelerating secular shift? We're approaching this material from the perspective of a value investor, using deep fundamental research provided by our sources. Just for context, our reference point is the market data as of September 23, 2025, and that closing share price of $141.03.
Right. And here's the core takeaway right up front, because this is interesting. While the stock seems, fairly valued currently, meaning you aren't getting a huge bargain today, there's a powerful external force that has just arrived.
A big one.
Yeah. And it's here to force radical restructuring. Change is definitely coming to PepsiCo, whether management likes it or not. Okay, let's unpack the core competitive strengths and the intrinsic value of this giant. Let's start with Chapter 1, business understanding. We need to get a grip on the business itself. The core concept here is pretty ingenious, actually.
It really is.
PepsiCo operates what they call the power of one. It's this synergistic dual-engine model. It leverages the fact that, consumers rarely buy a bag of Lay's without grabbing a Pepsi, or vice versa.
And that dual-engine structure is just crucial. It translates directly into immense bargaining power with pretty much every retailer they deal with.
This scale must be enormous.
Oh, it's colossal. In fiscal year 2024, the company generated nearly $92 billion in net revenue. They operate in over 200 countries. And get this, for brand power, they have an incredible 23 individual brands. Think Lay's, Doritos, Pepsi, Gatorade.
The big ones.
The really big ones. Each generating over $1 billion in annual retail sales. Billion with a B.
Wow. Okay, that's brand scale. But let's talk about their real operational mode. You mentioned something unique in North America.
Yes, the direct store delivery system, or DSD. This is key.
DSD. So they don't just ship to a warehouse.
Exactly. They own the supply chain basically all the way to the shelf. Their own employees stock the shelves, manage the inventory.
That sounds expensive, but powerful.
It is. It's like a logistical superpower, really. This fortress gives them unparalleled control over placement, making sure their stuff is at eye level in those end caps.
Prime real estate.
The bust.
Yeah.
And it gives them real-time feedback from the front lines of retail. That's a massive data advantage over competitors who rely on third-party distributors.
Right. Yet, even with this fortress, they are fighting that dominant secular shift we mentioned, health and wellness.
Consumers are actively avoiding products high in sugar, high in sodium, and that trend is now amplified, seriously amplified, by these GLP-1 weight loss medications.
Which are fundamentally changing nutritional habits.
Fundamentally. So this forces the company to adapt or, decline.
So how are they adapting? What's the strategy?
It looks like a clear buy versus build approach. They're trying to acquire relevance quickly.
Buying innovation.
Pretty much. We've seen this with high-value acquisitions like Poppi, the prebiotic soda. That was $1.95 billion back in March 2025.
Right, I remember that.
And C8 Foods, known for those grain-free snacks, for $1.2 billion in October 2024.
Okay, wait a minute, though. You said nearly $92 billion in revenue. Are these acquisitions, even at over $3 billion combined, actually big enough to, move the needle on the top line?
That's the essential question, isn't it?
Or are they more like strategic PR moves, signaling a pivot away from sugar?
Well, our sources suggest they are highly strategic. They buy category relevance, appeal to that younger, wellness-focused consumer. But you're right, to materially shift a $92 billion revenue base.
It's a drop in the ocean, relatively speaking.
Relatively, yes. They need much more scale from these acquisitions, or they need to execute massive internal reforms on their legacy products.
Yeah.
They're playing catch-up, definitely, but they seem to be doing it aggressively.
Okay, that brings us neatly to Chapter 2, management evaluation. The people running the show. The CEO, Ramon LaGuardia, he's been there a long time.
Over 25 years with the company. Incredible tenure.
So that suggests strategic continuity, you'd think?
You would. But the data seems to raise some questions about consistency, particularly in operational execution and maybe risk management.
How so?
Well, what's fascinating here is the contrast in how they've handled crises. Remember the 1993 syringe tampering hoax?
Vaguely, yeah. That was huge news.
It was. And management handled that brilliantly. It's seen as a masterclass in crisis management. They were transparent, worked with authorities, used video evidence to prove the claims were a hoax.
Protected the brand.
Perfectly.
Now fast forward to the 2024 Quaker Oats recall.
Yes, that felt different. Very different. This was a significant internal operational failure. The FDA actually issued a warning letter. They cited insufficient corrective actions for salmonella contamination that had been found in the facility in prior years.
Oof. So it wasn't a surprise issue.
Apparently not entirely. It's just an interesting contrast, isn't it? They handled an external attack perfectly back in '93, but seemed to stumble on basic internal quality control in 2024.
Yeah, that's a worrying inconsistency.
It is. However, if we look at capital allocation, the picture looks much more robust. PepsiCo is an esteemed dividend king.
Right, you mentioned that earlier. 53 consecutive years of raising the dividend.
53 years. That's a powerful commitment to shareholders. It implies very stable cash flow. And the dividend has grown at a 5-year compound annual growth rate of around 7%. Pretty solid.
And their capital efficiency, how well are they using their money?
Also confirms they run a pretty tight ship, generally. Return on invested capital, ROIC, stands at a very healthy 12.97%.
Okay, good numbers there. But here's where it gets really interesting, you said. Connecting management directly to external pressure.
Yes, this is the big news shaking things up right now. Activist investor Elliott Investment Management disclosed a substantial stake.
How substantial?
$4 billion. $4 billion disclosed in September 2025.
Wow. Elliott doesn't usually make small bets. What are they pushing for?
This is huge. Elliott is urging management to explore refranchising the capital-intensive North American bottling operations, essentially freeing up the DSD network.
Refranchising, like McDonald's does, selling off the operations.
Kind of. They want PepsiCo to emulate Coke's playbook from about a decade ago. Coke divested its bottling operations, became more asset-light, focused on high-margin branding.
So Elliott wants PPP to shed the expensive truck fleets, the warehouses, all the maintenance costs tied to that DSD system.
Exactly. The idea is it frees up billions in capital expenditures, shifts debt off the balance sheet, and lets management focus purely on the high-margin stuff, branding and innovation, not logistics.
That is radical, especially given how much you emphasize the DSD as their moat.
It is radical. It fundamentally changes the business model. That's the activist pressure.
Okay, that explains the pressure cooker management is in. Let's look under the hood then at Chapter 3, Financial Analysis. How are they actually using all this cash?
Well, the financials, they confirm the scale we talked about. Market cap around $193.08 billion. Huge.
But you mentioned a concern. Revenue growth.
Yes, that's the primary investor concern, and it links right back to that secular health trend. Growth has decelerated sharply. I mean, it was 12.9% in 2021.
Pretty strong coming out of the pandemic, maybe.
Right, but it slowed way down to only 0.4% in 2024. Just 0.4%, that's a significant slowdown. The massive scale seems to be hitting diminishing returns on the top line.
Okay, growth slowing. But profitability, you mentioned brand power.
It does hold up there.
Yeah.
The high gross margin, 54.68%, reflects that brand strength, that pricing power.
So they can still charge a premium.
They can. And fundamentally, PepsiCo remains a prolific free cash flow, or FCF, generator. They pulled in $7.53 billion in 2024 alone. Lots of cash.
But what about debt? Activists usually point to debt.
They do. And we do note a relatively high debt-to-equity ratio here, 2.12. That's quite leveraged.
Okay, high debt. And I also noticed, looking at the numbers, the current ratio is very low. It's 0.78. Usually, anything below 1.0 screams trouble, right? Means current liabilities exceed current assets. Why isn't that a massive red flag for a value investor here?
That's a really critical distinction to make. You're right. For a typical manufacturing or retail company, a low current ratio would signal serious short-term liquidity risk. Big red flag.
So why not for PepsiCo?
Because PepsiCo operates with these long-term contracts and has incredibly predictable, stable revenue streams.
Yeah.
People buy snacks and drinks every single day. Consistently, the cash flow is virtually guaranteed.
Okay, so short-term liquidity isn't quite the same level of urgent concern.
Exactly. They can afford to run leaner balance sheets. Because the incoming cash is so reliable, the stability of the business model itself kind of negates what would otherwise be a severe financial warning sign.
That's helpful context, thank you. So you've got stability, but slowing growth, high debt, but manageable liquidity. What does this translate to in terms of valuation? Is it cheap? Expensive?
Well, the relative valuation suggests the market is pretty neutral, actually. The current price-to-earnings ratio, the PE, is about 25.6,
And how does that compare historically?
almost exactly in line with its 10-year historical average, which is 25.49. It's uncanny how close it is.
Huh. So why the perfect average? What's the market thinking?
I think the market sees the stability and the cash flow generation, respects that. But it's balancing it against that enormous threat from the wellness shift and the GLP-1 drugs, and maybe the execution questions.
Makes sense. How about compared to peers, like Coke?
It trades at a slight premium to pure-play beverage peers like Coca-Cola, KO, or Keurig Dr. Pepper, KDP. And that premium is likely attributed to that highly profitable, diversified snack division, Frito-Lay.
So bottom line on valuation.
It looks fairly priced. No obvious bargain, no obvious bubble. The market seems to have weighed the pros and cons pretty accurately for now.
Okay, let's shift gears now to Chapter 4, market sentiment. What are the external forces saying? What's Wall Street's take?
Well, the analyst consensus rating is pretty decisive.
Yeah.
It's a hold. About 52% of analysts govern the stock rate as such.
So mostly on the sidelines, waiting.
Seems like it. They're waiting for the next catalyst, perhaps related to Elliott's involvement or a clearer growth picture. The average 12-month price target suggests only modest potential upside.
How modest.
Somewhere in the range of 4% to maybe 12.5% upside from that $141 price point. Nothing spectacular expected in the short term.
In the news narrative, is it all about Elliott?
Oh, completely. As we noted, the media narrative is totally dominated by the Elliott activist stake. The focus is all on that proposal to divest your bottling operations, to emulate Coke's playbook.
So that's defining the short-term story.
Absolutely. It's become the single most impactful news item, setting expectations. Technically, the stock is trading below its 50-day moving average, which signals some short-term weakness.
But are people betting against it heavily? Short interest.
Actually, no. Short interest is very low, only about 1.64% of the float. That confirms there isn't major conviction betting against the company collapsing or anything like that. People respect the underlying business, even with the headwinds.
Interesting dynamic. Let's move to Chapter 5, ownership structure. We mentioned ownership earlier, the institutions.
Right. It's highly institutional. Somewhere between 73% and 85% is held by passive index funds. Think Vanguard, BlackRock.
The giants. So stable but silent shareholders, mostly.
Exactly. They aren't likely to push for change themselves. But what's really crucial is the dynamic this creates when you combine it with insider activity.
What are the people running the company doing? Buying, selling.
Well, insider ownership is extremely low to begin with, just 0.11%. Barely any skin in the game, relatively speaking.
Less than 1%. Wow.
Yeah. And critically, the total volume of shares sold by top executives, including the CEO, over the last 12 months, it's been more significant than the volume purchased.
So insiders are net sellers.
They are.
Yeah.
And when senior management is selling, and their ownership is already tiny, it kind of reinforces the market's view, doesn't it? It suggests they don't see the stock as deeply undervalued at this $141 level either.
That is telling. Okay, let's explicitly address the risks in Chapter 6, risk assessment. We can sort of summarize the internal versus external conflict using a SWOT analysis framework, right?
Exactly. The dominant strength is clearly that DSD system, those $23 billion brands.
Yeah.
But it's constantly fighting the dominant weakness and threat.
Which is?
The perception of their core products being unhealthy, combined with intense and growing regulatory scrutiny. It's a constant battle.
Let's detail those external risks. What are the key threats?
Okay, there are several significant ones. First, regulatory. We're seeing growing global implementation of sugar taxes.
Yeah, those are popping up everywhere.
Everywhere. Plus advertising restrictions, mandatory front-of-pack health warnings. These directly threaten their core sugary and salty brands. It just erodes margin and demand over time.
Makes sense. What else?
Second, macroeconomics. Persistent food inflation. It's forecast to be around 2.9% in the U.S. for 2025. That squeezes their operating margins, costs more to make everything.
And finally, politics playing a role.
Definitely. Third, geopolitics. New U.S.-imposed tariffs are a factor now, specifically 20% on EU food imports and a hefty 34% on China food imports. Those were implemented in April 2025.
Ouch. So that adds complex cost pressures and supply chain challenges across their global footprint.
Precisely. It's not getting any easier on the cost front.
Okay, lots of risks. So let's bring it all together in Chapter 7. Conclusion. We've got strong brands, an activist catalyst, but also significant threats. Let's recap the bull case.
Sure. The bull case really relies on that wide economic moat, the DSD, the brands. Plus, that exceptional 53-year dividend track record signals resilience. And Crucially now, the arrival of Elliott as a potential catalyst to unlock structural value maybe force that refranchising.
Okay, makes sense. Now, the bear case.
The bear case centers on that secular decline of the legacy portfolio, the sugar and salt problem. Add to that the significant margin pressures from inflation and tariffs we just discussed. Then there's execution risk, highlighted by things like the Quaker recall.
Right.
And maybe most importantly for a value investor, there's just no obvious margin of safety at the current valuation. Management's own selling kind of underscores that point.
Okay, so if we try to put a number on it, the intrinsic value, what did the models show?
Well, this is where it gets tricky. Discounted cash flow, or DCF models, turn out to be highly sensitive to the assumptions, especially around that restructuring question.
So a wide range.
A massive range, actually. We're looking at a conservative estimate, maybe around $132 per share, but an optimistic estimate stretching all the way up to $234 per share.
Wow, that's a huge difference, over $100 range. If the model gives us such a wide disparity, how useful is it really in this case? What does that tell us?
Yeah, it's a great question. It tells us the future is highly dependent on two big unknowns right now. First, management's ability to actually execute this strategic pivot away from sugar and salt effectively.
And second,
The outcome of the activist pressure from Elliott. Will they refranchise or not? The market simply can't easily predict PepsiCo's free cash flow 5 or 10 years out without knowing if they'll still be an asset-heavy DSD company or if they'll become an asset-light branding powerhouse like Coke.
so the uncertainty is baked into that wide value range.
Exactly. And the current share price, around $141.03, sits right at the lower end of that very broad range. It reflects the market's balanced view,
Yeah.
respecting the stability in cash flow, but remaining deeply cautious about the slowing growth and the significant execution risk involved in this necessary but complex strategic pivot.
Okay, so fairly valued, but with huge potential swings depending on future actions. It leads to a final thought, maybe something for you, our listeners, to mull over. Given this tension between PepsiCo's 53-year dividend commitment, which really relies on stable internal cash flow from operations, and the activist push to streamline, possibly sell off those operations, which part, the power of one, the highly profitable snacks division, or the capital-intensive beverages division with its DSD network? Which do you think is most likely to be spun off or restructured first? That feels like the key question for the next few years.
It certainly does. And as always, just a reminder that this research was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please, always conduct your own due diligence and critical research.
Absolutely essential. Please do like and subscribe to Stock Analytics AI. Our members, for just $4.99 a month, get priority deep dives on S&P 500 tickers every single week. We're covering all 500 stocks over the next few months, and members get exclusive priority access to request tickers.
Great value.
It is. And if you just want a one-off request for a deep dive on a specific company, just drop us a super thanks on the video. Thanks for tuning in.